Okay. So first of all, of course, at the outset, we hope that all of you are safe at home and taking good care. We all are really experiencing an unprecedented event of this pandemic, and hope that we will come out of this and life will become as normal as usual. Having said that, the first thing which came to our mind every time and whenever we are making this presentation, that why are we talking about the tax issues? Let the business first run as normal and then we'll worry about tax. But at the same time, what we believe is that it is necessary that in the course of this unprecedented situation, one needs to take care of some of the tax issues, and which should not become an issue at a later point in time. So what we intend to cover, we will not be talking any generic issues, what's happening in GST and some of the judgments on that, but what we intend to cover a focused discussion on the COVID-19, the effect of lockdown, and the tax issues which are arising because of these COVID-19 situations. So what had happened really? First week of March or the second week of March, the things were normal. Nobody thought that we will get into this sort of a lockdown situation. Suddenly, then we had this lockdown and everything got disrupted. The business got disrupted, and we will get into the some of the critical issues such as some non-performance of certain commitments, non-fulfillment of certain statutory obligations. We will get into some renegotiations. We will get into certain re-looking at the business strategies. And at that stage, we will then endeavor into some damages and compensations and certain fines and penalties, and how we really need to deal with all of these situations. And therefore, what will happen when we start normally, we will have to live with a new normal life of whether it's for the business or it's at a personal level. And that's what all of us are now experiencing, and not only us, it's the entire world is really going through this sort of a position. What is happening because of this lockdown and because of this COVID-19 impact is that others move on to next slide. So what's happening is that you have a everything is getting changed, the changed customer preferences. The customers are really experiencing very different now. So be it the corporate B2B customers or be it a B2C consumers, because we have seen that every preference of the customer is undergoing a change. Something like the net thing which have started so much in terms of using consumption, so some of the guys are looking at that as an opportunity, whereas at the same time the usual traditional way of an entertainment feeling a threat of that situation. So if you look at it in an overall scheme, the customer preferences and the customer outlook has significantly changed. Second, a lot of businesses are looking at evolving a new products, new strategies, new offering, new way of doing the business, and that is under the discussion. The management is really looking at everything. At the same time, we will also need to face with regulatory changes. A lot of regulations are being effectively been introduced. A lot of new restrictions have been put. A lot of support in terms of incentives have been proposed. A lot of new set of policies being announced by the government, which is what we also need to really tackle about. And at the same time, keeping in mind our business reset is what we mean is looking at renegotiating the contracts with the vendors, looking at new terms with the buyer, looking at new terms of pricing policy for the product. And all of this business reset is what we are into that mode at this stage. And this is the new normal that we all are experiencing. And when we talk about this new normal, the tax cannot be left out, and tax will also need to live its new normal life. And tax needs to be taken care of as a matter of these new business scenarios. So what we intend to cover in this presentation is there are various scenarios which are arising in the course of this, which we'll have to deal with that and identify the impact of those. Secondly, there are certain government reliefs and measures which have been taken. There are some trade matters which are also critical to understand what is happening around the world. Just for your information, just for your appreciation, we are bringing in some perspective as far as world, what the different countries have taken the position in the tax matters to address their concerns, and then we will open for Q&A session. Let's get into the scenarios. Now, when we talk about scenarios, different events have occurred in last 4 to 6 weeks. So the first one, accrual and advances. Now, we all know that the accounting year has not changed. 31st March, and this time has unfortunately came at a time where we had all our year-end activities. And if we need to look at it all year-end activities in that period of time, we have this situation of doing a lot of accruals, and we'll have to deal with the advances in the course of the year end and the books of accounts that we close. Renegotiations, therefore, damages and compensation, immobility of a people and immobility of goods. It has been effectively a huge challenge today because the entire thing has been stalled, and therefore it may also have a tax consequences, and there are some miscellaneous risk and opportunities which are coming up. We intend to focus this discussion or this presentation in relation to all the consumer goods, be it FMCG, pharma, cement, and other industrial product, aerated drinks, and so on and so forth. And we have covered certain slides keeping in mind this sector group and identified certain issues which we have been looking at it. Clients have approached us understanding the impact of these issues. So let's get into one of the other, all of these issues. Now, GST on accruals and advances. What do we really mean by this? First of all, one fundamental principle is that merely because I am providing something in my books of accounts should not have any tax impact. Very clear. If I am booking something as unbilled revenue, I am showing something accrued expenses, that would not have direct consequences when it comes to a GST. It may have a consequence, clearly a direct tax, which is what we will talk about. But in the context of GST, merely I am passing an increase in my books of account may not have any consequences, except one issue which may come up in relation to the reversal of an ITC if you are writing off something in the books of accounts. So we will deal with that as a situation as well. But when we mean about the accrual and advances here, is that in a contractual understanding with my vendor or with my customer, I have agreed certain milestone payments. Now let me take a simple example of a renting of an immobile property. As a rent, I have agreed with my landlord, or if I being a landlord, I have agreed with my lessee that this is what the milestone for a rent, and at the start of the month, on the 5th of the every month, I will raise an invoice for the advance for the rent. Now what will happen in those cases? When I need to invoice on the rent upfront at the start of the month, or as per the contractual understanding, that milestone as defined in the contract will be considered as a time of supply. And if that is a time of supply, the GST liability will trigger on that time of supply. Now, this is not only a renting example. There are many such examples which exist, such as AMC, annual maintenance contracts that we have. There are many such examples. Many of you are going through some capex, and in the course of that capex, the contractor liability, contractor has finished his work, and we needed to effectively get a contractor is raising invoice as per the contractual milestone. Now, all of these nature of expenses which are agreed as per the contractual milestone, the time of supply will be as per provided the milestone in the contract. Now, can we therefore defer that invoice raising? And that's a $1,000,000 question which is coming up. Okay, can I not, my customer is not willing to pay this amount, should I not raise that invoice now? It's of course the problematic position. It's a catch-22 position, because till you don't raise an invoice on the customer, customer will never pay for sure. But at the same time, customer has already invoked the force majeure sort of a clause, has been effectively communicated to me that I will not be making any payment of these regular contractual obligations that I have. Then do I have an option in terms of the GST law not to raise an invoice? Clearly, if you don't amend the contract, there is no option exist. As on the date of milestone, within the specified time, it is a mandatory requirement for every GST supplier to raise an invoice on the customer. And we all know that whether customer pays this amount or not, the GST liability will trigger. This is proving to be a big cash flow scenarios wherein many of these issues are coming up on a daily basis. Now, one of the concern which has been raised to our notice is, okay, fine, I will raise an invoice as normal as agreed with my customer. Assuming tomorrow customer comes and renegotiated that value. So take an example. I have a maintenance contract for a 1 lakh rupees, and customer says, oh sorry, in this month I have not even used your services, but I will not pay you 1 lakh, I will only pay 50,000 bucks. Is that the adjustment possible in terms of reducing the value from 1 lakh to 50,000, or is there an adjustment possible in terms of giving the GST credit back to my customer? Now, in that context, we had one circular issued by the government in relation to circular number 137. What does it talk about? It talks about that if you have received, and this was only in the context of the advances received. This is a completely a different scenario, that if you have already paid an advance to your supplier and now that contract is cancelled, in that case, what circular clarifies that you can issue a credit note and you can do a GST adjustment. So circular has actually covered only one scenario, and that scenario being that advances has been paid and the contract is cancelled. Yes, there is a possibility to issue a credit note. If you have already issued an invoice, you can issue a refund voucher. If you have not issued an invoice, and do the GST adjustment. So far so good, no difficulty at all. But under this particular scenario, our very less number of cases are getting covered, because one, it is not that the contract is cancelled. You continue to avail the AMC services. You continue to occupy the space as a renting of immobile property. You continue to execute the contract in relation to the capex. But how can you say that therefore the contract is cancelled? So this scenario of cancellation of a contract is only one scenario which has been considered by the circular. But there are many other scenarios in the example that I had given which are not even covered by the circular, and the moot question which is coming up, can I do the adjustment and can I issue a credit note? All of you are aware that in terms of the GST law or the indirect tax law, first of all, the bad debts is not an excuse, or is not that you can take a shelter on for not payment of GST. Even if you have provided the service, if you have raised an invoice, and even if the customer has not paid you the amount, there is a statutory obligation on the supplier of goods or services to discharge the GST liability. Therefore, it is important that merely because this is a bad date and therefore I should not be liable to GST, that's not a good answer at all. Then what is the answer? Then we have section 15, which is a valuation aspect, and we have section 34, which allows me to issue a credit note. In both the scenarios, in section 15, you can give a discount only if it is known before making a supply. So section 15 has a very limited scope of giving a discount, because section 15 requires that it is known before making such supply. Now, in case of an annual maintenance contract, what is the time of supply? Time of supply is every milestone as defined in the contract. Now, milestone for the month of April has already occurred. Milestone for the month of March already occurred. And if that amount is not being paid, can you say that this is discount given by me when our time of supply already occurred and this was not known before the making of that supply? So very important. Yes, May, if you negotiate in the month of April, and in the month of May, if there is some milestone payment being paid, one can take a position that May discount is given to me before the time of supply, and therefore that should not be liable to GST. But for the month of March, for the month of April, where the time of supply has already occurred, and now you are giving a discount and you are waiving the charges, that may not be the flexibility available under section 15. Section 34. Section 34 is limited in its scope, where the adjustment is possible only on account of change in the value or a deficient provision of a service. Now, contractually, whether parties will be able to agree amongst them that this is deficient provision of service and therefore the adjustment is done and I am effectively issuing the credit note. So it's again a little limited scope, while one can stretch this into the section 34 and issue a credit note. But I must tell you that these sort of scenarios need to be examined on a case-to-case basis and then take a call on this aspect. Because when we talk about this accrual and when we talk about these advances being paid, when we talk about this sort of a milestone payment being agreed on a particular date, are we really taking care of a GST issue? Commercially, this is being agreed between the parties, but GST also needs to keep in mind that what will happen to the GST element of that sort of a renegotiation of the milestone or the value or the time of payment in terms of the contractual arrangement, and is that being properly given effect to in terms of the GST law. So this is very important an issue which is regularly coming up. Now let's come to the next issue, which is taking the cue from the first issue itself. We have seen in multiple cases in last 2 to 3 weeks, wherein as a part of a renegotiation of a contract, there has been some damages or a compensation is required either to be paid or received by the companies. Let me give a simple example. Like one of our client was carrying out the Mumbai Metro work, and in terms of the Mumbai Metro, assuming because everything is now halted, there is absolutely no work is going on, and the client has actually started preparing the claim statement against the state government and requesting for a claim. The claim worked out to be say 100 crore rupees. Now in that scenario, when we were examining that claim statement and we told the client that what will happen to this 100 crore of a claim as far as GST is concerned. Metro projects are liable to 12% GST. Some transactions are liable to 18% GST. What will happen to this 12 or 18% of a GST element on this 100 crore? And if you don't contemplate that at this stage itself, and assuming state or any government body agrees with your 100 crores of a claim, who will bear the burden of 12% GST? And you will effectively end up having GST paid on that 100 crores, you will end up receiving 88 crores rupees of a claim. Would that be acceptable in the business scenario that we are going through today? Now the moot question which is coming to our attention every now and then is, when I receive the compensation, when I pay the compensation, damages or claims, is it in a first place a supply itself liable to GST? And that's a bigger issue that one needs to really examine. Now let's examine our charging section, which is section 7, which is a supply definition as provided under the law. Now what does it say? Supply includes, okay, so supply includes, and it's an inclusive definition, all forms of supply of goods or services such as sale, transfer, barter, exchange, lease or whatnot, which is been done for a consideration by one party in the course or furtherance of business. Now that is what the wider definition is. Others, I can't see that definition. Have you changed the slide, please? Yeah. So if you look at it in terms of this wider definition which you have here, that all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, license, lease, agreed for a consideration by a party in the course and furtherance of business. This is clearly in the course and furtherance of business. This is by one party. There is a consideration in the form of damages, claims, whatever compensation. You know that the terms goods or services as defined under the GST law are much wider in its scope. Goods means anything as a movable property, and services means anything other than goods. So everything under the sun could be goods or services. So if on a plain vanilla reading of this charging section, one may take a position that every commercial transaction which is not covered in Schedule 3 is effectively considered to be a supply. However, we would like to bring to your attention to the word in the charging section, which is a supply. Which, what does it mean? Supply includes all forms of supply. So it is an inclusive definition, and this supply concept which is provided in charging section is not defined here. And when we looked at it, this supply as a verb which is not defined under the law, then one needs to take a dictionary meaning of that supply and take a shelter of that, and that would mean in terms of the dictionary meaning of this term supply, mean doing something positively for the other, doing something as a commitment, providing something to some other person, then only it will be considered as a supply. We were doing this sort of an analysis, and we could lay our hands some international jurisprudence, because this concept of supply exists globally, and we could find some New Zealand ruling, one Australia ruling, and fortunately 2 weeks back we also had one Bombay High Court ruling, which is not exactly on this issue, but one could take some benefit of that, which says to furnish or to make available or to provide something to the other. That means you will have to do some positive act of providing something to constitute a supply. Now in that context, one may be able to take a position that simpliciter damages or a compensation or simpliciter certain claims may not be liable to GST. However, this will all depend upon fact to fact. One underlying principle which is evolving in this case is, if the underlying transaction involves certain supply, then this will still be considered as a consideration and liable to tax. If the underlying transaction does not have any supply, then there will not be liable to tax. So when we looked at it from that perspective and analyze the different scenarios which is coming up there, the first scenario is, others on the table please. The first scenario there is compensation for delay in payment for consideration of supply. So somebody is making a delayed payment of a consideration. Clearly, that is provided in the GST law also being liable. This will be liable to tax because the underlying transaction is a supply transaction. There is merely a delay in making payment of that consideration. Therefore, that will be liable to supply. Second is compensation charges in the event of cancellation of an order. Now, if the compensation and charges on account of cancellation of an order, because there does not exist any underlying supply, there will not be required to pay any tax liability, because one may say that there does not exist any supply transaction. However, this position to be tested and may be litigious in that context. Now, what will happen at the recipient end? That if you are a recipient of a goods or a services and you are effectively charging from your vendors some compensation or a claim. Now when you are charging a compensation or a claim from a vendor, which is therefore as a recipient you have never provided any supply to your vendor, one may take a position that will not be liable. But the best scenario would be that this is nothing but an adjustment in a consideration value, and the consideration has been effectively renegotiated and has been brought it down. Whenever recipient claims something, so in that example, assuming a state also comes back with the metro guys saying that you have not done work on time, therefore your contract value of say 1800 crores should ideally now become a 1700 crores. Then it is readjustment in the contract price itself, and there is no separate charge by the recipient to the vendor or the contractor. So what you will have to examine, that am I separately raising an invoice on the recipient or vendor, or it is merely a price adjustment which is happening, which should not be liable. Therefore, one conclusion which is coming out of this entire discussion is that this treatment of GST on this sort of a transaction will depend upon every fact, every nuances of that fact, every case, and the time at what point in time these adjustments have been done. Therefore, what we believe all of us are really doing going forward. The first thing first, study the contractual scope. Study the contract in detail. What does our main contract talks about? What does my purchase order talks about? The second, analyze the tax implications on any of these amendments of that contract. Second, third, decide on the timing of such amendment, because deciding on that timing also is very important, because at what point in time you are carrying out that amendment decides the tax liability. Fourth, also examine whether there is commercial burden of these taxes will be passed on by to whom. Is it vendor, is it me, and is it customer, or is it me? So and analyze that who is taking the commercial burden of such taxes. Then restructuring if possible to minimize the burden. And last but not the least, then amend the contract, put it black and white in writing what you have done as a restructuring, because tomorrow what you agree, what you do, and if it is not supported by proper contractual language, you will have a challenge in the defending this position either at a tribunal and beyond. Therefore, amendment to the contract is a very important aspect. Why we are bringing it all of this to you? Because we have seen invariably in all those conversations, your commercial team or your legal team is putting together and securing the legal aspect of it, but the GST angle has not been kept in mind. Therefore, the language which is provided in the amendment may not support the GST position, and therefore we need to be very careful about in terms of this sort of transactions. And this is likely to be more often and not in this sort of a scenario, and we need to be completely careful about any of this renegotiation, restructuring of a contract, whether in terms of claims, damages, or compensation. One of the query came to our notice yesterday is that fine, I am effectively I have a say labor contractor, and the labor contractor effectively is providing my services on a monthly basis. In the month of April, while he has not provided me any labor, but I am deciding to make him payment, and it is like a gratis payment, or the state advisory also suggests that you don't hold any labor's payment and I am making the payment. Would that be liable to GST in the first place? And the second, will that be available to me as a credit in the second case? Now let's examine both these transactions in that manner. If you look at it, that these transactions are liable to GST or not, when you are making a payment to vendors, are you making a payment in the context of love and affection with the third parties? Answer is no. Can you really call it this as a gratis payment? Because eventually you are making this payment because he has provided the services either in the past, and you expect him to provide the services in the future. So taking a position that there is no underlying supply at all, and therefore I am just making a payment as a matter of donation, or as a matter of supporting this thing, then are you treating this as a CSR spend that you are making? If yes, even then it will be very difficult to establish between the company and the vendor that I am making the payment to vendor as a simple third party payments, and whether it will be liable to tax. It is, according to us, may be exposed to tax, and therefore it may not have a position that it is not liable to tax at all. And the second one is that once it is liable to tax, it is somehow related to certain supply, and therefore the credit will also be available to you. So there are some of these transactions which are also coming up regularly in terms of these issues which are coming up. Coming to the others, go back to our earlier slides. Let's examine the income tax implications on these payments. We have a situation where if this is a receipt in ordinary course of business, this would be taken as a revenue receipt and will be required to offer to tax. But if this is in terms of compensation paid for losing a business opportunity, and therefore it is not a regular in the course of business I am receiving this, one may stretch it a bit, saying that this is a capital receipt and may not be liable to income tax. However, again, it will depend upon case to case, and whether this is a regular business opportunity or not, and whether this is loss of opportunity and the payment being made will be decided, and therefore the treatment for income tax for these damages will again depend upon under what circumstances these payments have been made. Moving on to the next issue on income tax again, that let's go, that now there are a lot of restructuring arrangements which are happening, and this is affecting our day to day planning. So revisit the future cash flow and projections to arrive at a current valuation. Very important, because we will have advanced tax liability also coming up. We will also need to plan in terms of our tax liability. We also need to look at it, the TDS exposure which is getting there in terms of these payments. More importantly, payments under 195, 197 also will have to be examined, because all the foreign payments also, there will be a planning which is required to be done, because if you are accruing something, not paying TDS and all of this also will have some consequences of that. Then challenge in terms of forecasting the impact of COVID on future revenues is also an important position. Reconsidering impairment of book of value of assets, because now why we are bringing all of this aspect is also there are certain incentives which have been granted depending upon book value of asset. Second one, there are certain issues which are coming up in relation to new corporate tax structure, which is 15%, and therefore how can I really now do it in terms of setting up a new company, taking a benefit of new corporate tax, and so on and so forth. So all of this planning will have to be done in terms of keeping in mind the renegotiation, restructuring that the businesses are going through, and then only will have to be taken care of. This is all about the first two issues of the accruals, and in terms of response to this contract and the renegotiation and thereabout. Let's examine how the businesses are now evolving. Businesses are evolving into three or four basic fundamental things. One immediate attention which requires is a liquidation of the old inventory, where many of the marketing team have already started evolving the new schemes and dealing with these issues on a day-to-day basis. Then easing out the financial stress in the distribution and a supply chain also becomes a very important in that context, because now the distribution and supply chain is important in terms of now day and age. And at the same time, one mantra which is everybody is looking at is preserving the cash, and therefore how can I get the cash in early date, try and get that cash and improve my cash flow position. Revisiting the contractual arrangements and adhering to these new workplace guidelines post the COVID situation, and some of the CSR activity on humanitarian ground. Clearly, these are the response that business is really giving to this COVID situation. Each of these responses and the event has some consequence in terms of the tax. So let's examine all of this once again. First one, the compensation to business partners. Are you making this as an ex gratia lump sum payment? As I examined in the context of the labor supplier, can we say therefore this is liable to tax in the first place? I think depending upon the transaction, this may be liable to tax in that, really in that context. Looking at the second aspect there, in terms of now, because we want the inventory to be liquidated at an early date, what will I need to do now? One, I will offer the discounts. I will come out with the new schemes and promote my products. And we just discussed in the context of accrual also, that if such discount is for the future supply, no difficulty, you can give that discount in an invoice, and as per the revised price, you can start discharging GST. But if it is for the post supply, the goods are lying at a distributor end, the goods are lying at a retailer end, and you are giving the post supply discounts to your customers, clearly GST law does not permit this sort of an adjustment to be provided, and therefore you will not be able to issue a GST-able credit note, You maybe only need to issue a commercial credit note to your customers. Now we all know the one last time the circular which had come and created some havoc in the market. While the circular has been withdrawn, but you can't stop authorities taking an interpretation that this is nothing but a supply of service by the distributor to the manufacturers or to the brand owners, and therefore it should be liable to tax. And you can't read this as a discount. While we won't endorse that view for sure, but will it not expose our distributor or a dealer to a litigation? And in that sense, we'll have to carefully plan this entire discount strategy post supply. Anyway, the discount pre-supply, clearly no difficulty, it's a price variation. But discount post-supply, we will have to carefully put in place in terms of the entire scheme. Otherwise, we have an exposure wherein, while at our end we have no exposure as a companies who are supplying the products, and you may very well give a commercial credit note. There is no bar on that. But at the customer end, at the distributor end, at the dealer end, there may be a potential risk of authorities taking an interpretation that this is nothing but a supply of service by them and it should be liable to tax. While that is ideally not a sustainable position, but if we can avoid that litigation, that is what one should be really careful about when we are evolving a practices of post supply discounts. Moving on to the next issue is in terms of inventory losses and ITC thereof. We had a different scenarios which had arisen, that the goods what I was manufacturing were perishable goods, got damaged. Goods have lying in the premises got expired. It could not be sold. Third, inability to effectively attend the critical care needs also, wherein this also got effectively lost in the system somewhere. And we have a provision under section 17 that ITC is specifically denied in the context of lost, stolen, destroyed, and return of quantities and goods. Now, here, many of you have a policy that if goods are expired, even if it's at a retailer end, you take back those goods, especially in pharma, and this will be treated as expired goods, or then you get a disposal of this in terms of that. While pharma may not be facing that challenge because pharma is the only sector which is in full demand at this stage of the COVID situation, but there are other cases wherein a lot of these perishable goods have got damaged or has got been expired, and therefore the issue of reversal of ITC clearly is knocking their door, because the language of section 17 is much wider in that context, because anything which is lost, stolen, destroyed after expiry, also destroyed in that context. And therefore one may look at it that there will be a need for reversal of a credit, even though this is a clearly a business loss on account of unforeseen events. Now in that case, we believe that this is one of the fit case that one should be really making a representation as a policy one, saying that this is clearly unprecedented compulsion on being a lockdown. The goods could not be been sold, and therefore this is not the ordinary loss of this is not a loss in the ordinary course of business, and therefore the credit reversal should not be required. But till that clarification or till that amendment is issued, we believe that there is clearly a risk of ITC being lost on those goods which have been lost on account of this lockdown position. Moving on to the consequence issue of this, when I go and claim the damages in the form of insurance claim, the goods which got damaged, and I have an insurance claim and I want to claim it from the insurance companies. The first issue is this insurance claim per se is considered to be a supply. Clearly this is been held in multiple times that this is nothing but a transaction in money. Claim settlement is the transaction in money. You will receive this money only, and therefore no GST applicable on this insurance claim that you will have. But at the same time, because this insurance claim which is coming up, first you have already reversed the credit being ITC loss. When it is shown as a claim amount received in the P&L account, then somebody will say and say, oh, this is nothing but a non-taxable supply and you should effectively reverse the credit. We believe that is also not required. Proportionately on a common ground, it is not required because this is per se not a supply, because the transaction is money and excluded from the definition of per se as a supply, and therefore this should not be covered even in the context of being not an exempt supply, and therefore no additional proportionate reversal will be required. So two things: insurance claim per se won't be liable, neither on account of receipt of claim you will be required to reverse something. But what one can really look at it, the ITC loss which is happening on account of these damaged goods, one can include that as part of an insurance claim. We have seen that in the past that insurance companies have settled these amounts. If there is a loss of goods or damaged and there is a on account of ITC reversal required, you may include that as part of a claim when you claim this insurance from the insurance companies. Moving on to the next issue, now mobility hurdles for the people. And mobility hurdle, the priority issues in the context of individual. You all know that we had a new residential rules wherein number of days stayed in India is 60 days or more and cumulatively 365, then you will become a resident of India. Many of our clients have approached us. Now he's stuck in India or he's stuck outside India when he went out for a business purpose. Will it now be considered to be resident of India or resident of that country? And to answer to that issue is appears to be yes, because there is no relaxation provided by India that if you are stuck on account of this lockdown and you are in India for more than 30 days and 40 days, when it is crossing your limit of being resident in India, then there is no relaxation provided. Unlike in Singapore, in fact, Singapore has come out with a specific policy that this lockdown period will be excluded when we calculate the residential status. We will deal with that when we talk about around the world. But this is the biggest risk that many of the individual level people are looking at it. And therefore, what is the risk at the company? That if individual becomes resident and you've been effectively paying any amount, this entire amount will be required to be taxed and TDS is required to be deducted accordingly. And that is also one needs to be careful about. And secondly, in terms of the poem risk, while it may not be as grave a risk as it is, but if you needed to go out and conduct the board meetings and to show that there is no control, effective control in India or effective management is not in India, then that also will be diluted because physically you can't go out and conduct the board meetings for the companies where you have effective control and therefore your board members cannot have those meetings being conducted. So place of effective management also one needs to look at it when it comes in the context of mobility. Moving on to the next issue, which is the mobility of goods. Now, as you know that goods have also been became immobile today, and the goods cannot be really moved because of various reasons. Now, there are different scenarios. The goods have been arrived at a port, bill of entry got filed but got stuck at port. Goods have started from a port or from a supplier and stuck in transit. Goods have not been received in my factory because it has stuck outside the factory gate a long time and I couldn't complete the GRN and therefore goods are again stuck. Now, what is the consequence of all of this? The first issue is, can I take a credit? So let's take a hypothetical example. Say on 25th of March, I have filed a bill of entry and I have paid the GST. And the goods have still not received in my factory. So GRN will happen sometime in April end or sometime in May. What will happen to those 1 month of IGST which is get locked out in this scenario? And one of the interpretation which is coming up is that the section 16 requires you to receive the goods, not receive at the place of business. And therefore, once you have filed a bill of entry and taken the custody of these goods, one may take a position that I have effectively received the goods. It has not been received at a place of business. Even though the GRN has not happened, one may take a strict view that the credit is available. but this is definitely not free from litigation. There is likely to be a litigation on this issue, but if it is going to be a big cash flow event, if the large machinery had come, if the large quantity has been stuck in transit, one may look at it this sort of a provision and still take certain benefits. The second is export turnover. Clearly, many of the goods have actually started from a factory but could not be exported outside India because the shipping bill could not be prepared. You all know that the export related refunds are linked with the shipping bill clearances and it is automatically granted. This is also badly impacted. So if you can push your CHA, because customs have been operational fully, if they can prepare a shipping bill as soon as possible and get this shipping bill generated, at least your IGST refund will start flowing in. And credit reversal on the goods lost or damage in transit. So let's look at in a scenario where your vendor has supplied the goods. Goods got stuck in transit and partially damaged. And you receive in that damaged scenario goods in the factory as your input. No difficulty, as long as you receive the full quantity, you can take a credit even though it is a damaged stage. And what you will do with that, if you give that big back goods to your vendor, then you can follow a procedure as if goods returned. If you sell these goods to your third parties, you again need to pay the GST and clear those goods. No difficulty. But take a scenario where vendor has supplied the goods to you, goods are in transit and the quantity is not in a full manner has been received as originally invoiced. In that scenario, because you have not received the goods as quantity billed in the invoice, you will not be entitled to take a credit to the extent of that quantity. So this is again another scenario which is happening because goods have been lost in transit from vendor to your location, and therefore the credit is also getting denied to the extent of quantity lost in transit. Move on, others. Now coming to the next issue, the CSR and the ITC related thereof. Lot of CSR activities going on, and some of them are mandatory, some of them are not mandatory. Then will I be entitled to take a GST credit? Now, when we had examined this position, the CSR could be offered two types of activities. One, this could be purely a cash contribution. Then there is no question of GST being imposed and no question of GST credit being available. But at the same time, if this is actually in the kind, you have bought the goods and you are now distributing this free of cost to various beneficiaries, what will happen in that context? If you are buying this and giving to a beneficiaries, the first question is it in the furtherance of business or in the course of business? There are one view that if it is part of a mandatory CSR which is required to be spent under the Companies Act, clearly this is in furtherance of business. But if it is not mandatory, this is not getting covered as per the schedule 2 of the CSR, then one cannot say that this is mandatory and therefore it may not be considered a furtherance of business. However, we have one judgment in case of SL Propac, wherein the tribunal has taken a view that even if it is not mandatory and you are distributing this is actually raising the status of the management, raising the bar for the companies at a different level, and that will help them in the long run for the business purpose also, and therefore this should be considered in the course of business only. Again, an interpretational issue. But assuming we cross that threshold, that it is in the course and furtherance of business, will it still be available? Because we also have a bar under section 17(5) that if you give something in the form of gift or a free sample, then that credit is not available. Free sample clearly is the free sample which we all know typically in a pharma industry or a FMCG, where they are free packed, not for sale, sort of a sample packaging that we do, and they have been distributed free of cost, no credit available. But the more worried factor is the term gift. The gift is not defined, and gift would mean giving donation, gift would mean giving something without reciprocity of something, getting it back from the the respective person. Clearly, in this sort of a distribution free of cost, one may get covered this in the term gift, and at that stage, one may need to look at it, the reversal of a credit in that context. Now, taking the clue from this issue itself, there are free supplies which have been done for the purpose of mm, either guidelines issued by the state or on a suo motu, such as masks, sanitation, and some of the other related items to fight for the COVID-19. Now the issue really coming up again, I am freely distributing this. Can I take this as a credit? Now again one need to start evaluating from both the perspective. Is it made a mandatory by the state government to distribute free? We have seen that the state government has issued the guidelines to the manufacturing, large manufacturer in their state, that please distribute this to the needy people in their region, and they have been doing this. So can we say this is a mandatory or in the furtherance of business? But even assuming we cross that threshold, one needs to examine the 17.5 reversal requirement as far as gift is concerned. But can in that case, when it is mandatory, been asked to give it to somebody, am I really giving that as a gift also? Is a big question mark, and will come up with a lot of interpretational issues. Clearly, one more policy representation here. One should make a representation to the council that these supplies should be considered either zero rated, or the bar of 17.5 should not be made applicable in this sort of a cases. One frequent question is coming up about deductibility, this from the income tax perspective. See, if something is considered as section 37 in as part of a CSR activity, clearly this is not allowable as deduction. But something which is not considered as CSR activity but as a mandatory requirement as per the guidelines issued by the state advisory, and we were asked to do that, one may still say this is not a CSR, and income tax should be allowed as a deduction, because this is a mandatory requirement for me to distribute this, and I am not treating this as my CSR spend. Again, depending upon what treatment that we give to this sort of action that we are doing, will decide the deductibility under the Income Tax Act. Moving on to some of the regular issues which are coming up now in the context of impact of COVID, that if we want to run the factory, we are mandatorily now required to provide the sanitation facilities at workplaces. We will also need to provide and buy certain equipment such as this temperature measuring equipments and all. We also need to procure certain mask and PPE's kit, which is mandatory required in terms of the guidelines if you want to start our workplace. One of the issue coming up in this context also is that would that be available as a credit or not? And there we had examined this in the past also, as you all are aware, when it came up in terms of the safety shoes, the safety mask or safety gloves, the tribunal has been taking a consistent view that this is not for the personal consumption as contemplated under section 17, and the credit should be allowed. We believe that even in this sort of a procurement is not to be considered for a personal consumption as provided under section 17, and credit should be allowed. This is as a mandatory requirement also to work at a workplace. You want to carry out my day-to-day operations of my business, and this credit also should be allowed as part of a routine activity. Moving on to the next issue is some common ITC and timing of availment thereof. There are common credit that we take regularly. Now one needs to start planning it keeping in mind the different business scenarios, because for all the credits taken in the last March, which is March 19 or March 20, one can take a credit up to September 20th, September 2020, and therefore we have a time either to take a credit in the last year or this year, and one needs to plan keeping in mind their business scenarios, how much is the exempt supply, how much is likely to be a taxable supply. Even the credit which is coming up in this year, one can look at it, when do I really avail that as a credit, because that is how the planning can be done to some extent, while it keeping in mind of course the cash flow scenario. by deferring from March to April may not have any big cash flow impact. But if my ratio is going to change in terms of the exempt supply and a taxable supply, it may be better off a plan in terms of the credit. When do I really avail that? The availment of a credit will decide my ratio and not the date of an invoice of the supplier. So very important in terms of the provisions, the date on which I avail the credit and ratio of that a taxable and exempt supply will decide my creditability of that particular service, and therefore one may need to examine, should I avail that in March or should I take it that into an April. Last point on the next slide please, wherein one of the new issues which are now coming up in terms of the shifting of customer focus. What's happening now? Because now we have a new customer preferences, lot of new products which are in immunity, hygiene, shelf life are coming up. And what is becoming very important in this context is the classification of goods and the regulatory aspects thereof. I'm sure your regulatory team will be looking at the compliance of that from the regulation requirement, such as if you are buying manufacturing sanitizers, you may need to have a state excise permission, so on and so forth. There are various regulatory requirements. There are some price control requirement that is there. But the core issue from a GST perspective, what is the rate of tax? Now, let's take a simple examples which we have taken illustration, that if you are manufacturing a sanitizer, then the classification would be either 30, 34, 38. And 30 and 34, the rate is differing. If it's a medicament, a medical grade sanitizer, the rate of GST is 12. If it could fall into a cosmetics, rate of GST is 18%. Similarly, if now ready to eat food, that is all new era, new businesses which are coming up. And then whether it's a chapter 21 or any other chapter, whether it's a sweetener, sweet meat, or whether it's a namkeen, whether it's a fasari, all of these ready to eat food will also decide what is the rate of tax applicable. And I must tell you that there are different rates applicable depending upon the package that we have. If it is put up in a retail package, the rate of tax is different. If it is a wholesale package, the rate of tax is different. So depending upon what product in question, what is the packaging that we are using, then the GST rate will be decided. So given the new customer focus now, new products being launched, one needs to carefully examine what is the rate of GST applicable for such products and such sort of packaging that I am really using in that context. One more issue in the context of now under the new era, there are few products which have now gone back to 18% to 12%. Some of the products are 5%. Now to push the inventory in the market, if we start having a different combination of products which are applicable at a two different rate of tax, some of them are 18 and 12%, some of them are 12 and 5%, then we also have a definition of what we call it a mixed supply. And that mixed supply is, the law requires that whatever is the highest rate applicable is required to be charged in that combination of a package. Because if you are charging one price for the combined package, then you may have an exposure being treated this as a mixed supply, and the highest rate of tax may be applicable. Therefore, all of these new policies, new inventory liquidation strategies, and if you are trying to sell two products together at one lump sum price, then we will have to examine, are these products of a two different rate category, and then accordingly calculate the GST impact. Otherwise, as we all have been doing for the years now, for last 2-3 years since implementation, that we identify an individual price of a product which may be sold together but at an individual price and not a one consolidated price, then one may apply a different rate of tax for that particular package, as opposed to selling at the entire package at one price and then get exposed to the higher rate of tax. Again, an important thing in the new era of business, all of these new combination of products which are liable to different rate of tax may have certain potential exposure in that context. Yeah, Adarsh. Again, one two slides on GST on a distribution and delivery solutions. We have seen that now everybody is looking at a last mile delivery to the customer, to the consumer, and different set of services which have been availed, whether it's a courier company, whether it's a GTA service provider, what is the last mile services which have been availed. And each of these distribution network and the delivery solution has a different GST impact. And one needs to, because the classification changes. The courier classification is a different than the GTA classification. GTA also we have two rate structure now. One is 5%, one is 12%. 5% in case of a reverse charge mechanism. 12% is in case of a forward charge mechanism. So we have a different rate structure. We have a different sort of modalities which have been used for the last mile delivery, which have been provided as per need of an hour, and therefore one needs to examine in this context as well. What is that delivery model or delivery solution which is being worked out to avail the benefit and minimize the tax impact. One of the important aspect which comes up here, why are we bothered so much? Let it pay whatever tax applicable and we will avail that as a credit. That's not good sign. I must tell you, because nowadays preserving the cash is the mantra. If you have a scenario of accumulation of a credit, why are we getting into a scenario where you pay the tax and accumulate a credit by paying the higher tax? Can I really do it in a different manner to have a minimum impact of tax, and then looking at a different perspective of a transaction? Yeah, Dash. Now, last point is the evolving strategy. Before I request others to take on some of the government measures in terms of impacting the COVID situation. Now, there are certain evolving strategies which is happening. Now, others, you can go to the next table there. So, for example, we have a scenarios where many of our clients were waiting for April 1st to implement the cross charge, because we had the different series of interpretation whether employees CXO CEO's salaries to be cross charged or not. And the interpretation is that ideally this is a salary is not required to be cross charged, but we had some series of advanced rulings where negative views have been taken. And to avoid that, many of our clients were looking at getting into ISD cross charge mechanism from 1st of April. But now, given the new era, is it still possible to go for that? Is it have implications of an accumulation of a credit at a different level? Then also looking at intervening periods till we get a normal operational period start. What is the strategy I need to use for GST? Then administrative challenges are also coming up, where my customers are not paying GST. Should I deposit on my own? What do I really do? Should I avail the benefit of this option of with a 9% interest? So these are administrative challenges, the cost benefit analysis, and more importantly now, do I have an option to obtain a separate registration now? Because this concept of business vertical has gone, and therefore product by product or some sort of a distribution center by center, is it worth availing a separate registration so that I minimize the impact of any loss of a credit, or I now merge two registration into one registration so that I use the accumulated credit in one registration effectively with the other registration?
इनकम
So
तो
have a separate registration or merge two registration.
आपका
All
तो
of
7
these
करोड़ ही है बस वो आपने
all of these strategies are in play now, and one needs to be carefully looking at it in terms of evolving strategies post the COVID-19 situation. Yeah, that's manpower also, as we discussed already, the in terms of labor issues which are coming up, where are restrictive in terms of interstate movement, and it may of course have an impact in terms of cash flow and what you are paying it to the labor supplier for an intervening period. Yeah, Adarsh. There are certain transfer pricing considerations also. We have an intercompany charge, and typically this is on the context of the international transaction, where the cost plus markup has been agreed in a particular way. We have seen that already the requests have come from a global side that we have been paying you cost plus 17.5%, cost plus 20%. Now we will not be paying that, and please reduce that to cost plus 10%. Now there are two, three consequences that we need to examine. First, is that cost plus 10, 12, 15% acceptable to the TP authorities? It may not be. Some of them would have already got an APA and so on and so forth. But the second one, that assuming for the TP purpose you continue to show cost plus 17.5, but commercially you charge only cost plus 10%, will it have an issue on the GST that this is not the value which is should be considered for the purpose of GST, because then you have undervalued the goods. And the consequence of that is mainly in the context of export of services, because for export of services, one of the condition is that you receive that payment in a foreign exchange. If you don't receive that payment in a foreign exchange, then clearly you will have an issue in the context of doing the out of the books adjustment only from the TP perspective, but not receiving this money physically will also exposure to GST, because you will dilute your position. This is not being an export of service. So all these markups, all this one time support which is received, many a times it is reverse, that the foreign companies which are parent companies are providing a support as one time support to an Indian entities. Now when you receive this sort of a support as a TP adjustment, because Indian entities are not receiving or having that much of a reasonable margin which is offered to tax in India, and you are receiving the one time support charges from a foreign entity, what is the treatment that you will give for that? Will you say this is export of service? Will you say this is nothing but a price adjustment of the goods which have been supplied by a parent company? One needs to be properly examining and documenting such transaction. Either India entity receiving or lesser charging to a foreign entity, or foreign entity paying to an India entity as a support, as a one-time support charge for the purpose of transactions not having a reasonable margin in India. All of this transaction will have a significant impact of the GST, which one needs to be carefully examine and document nicely in that context. Now, others, I would request if you can take up on this certain government measures. We are already in terms of running out of time, but I'm sure others will take up some of the important issues and bring to your notice what government has done till date in terms of this COVID-19.
Sure, sir. I think what we need to understand broad-based, and I'm sure that some of these amendments that have come through, either directly through the ordinance or through subsequent notifications, most of you would have noticed. I think the larger construct of what has happened as a matter of relief here is that, in terms of timelines which were falling due between 20th of March and 29th of June, all of those have been extended to 30th June. And this applies equally in terms of action that a taxpayer has to take and the actions that the tax authorities have to take. So to that extent, I think wherever you are looking at any timelines, to be adhered to or to be addressed, etc., I think it will always be a good checkbox to go back to the ordinance on notifications and understand whether that is going to be covering your case or not. Specifically, two kind of questions that come up on the direct tax front is at least at an individual level, whatever planning avenues you have, whether it's ATC or investments corresponding to capital gains and so on and so forth. Some of those things, if you can still manage by 30th June, you will be able to take an adjustment for financial year 1920 or the assessment year 2021 as the case may be. And the second and the most interesting question that comes up now that we have something called a PM CARES fund is that if I contribute to PM CARES fund between April and June, will I still be able to make an adjustment to my taxable income of the previous year? My sense is I think this is all contributions for good cause. I think we should be more focused on that. And deduction, whether in year 1 or year 2, whatever the case may be, would be available. So we should not be too much bothered about that. On the direct tax front, I think the other important aspect is that there is a grace period to make certain payments. Whatever is falling due between the timelines that we've just spoken. If you make the payment not on the original date, but within 30th June, you'll be able to enjoy a reduced interest rate of 0.75% per month. You can excuse.
Others, you need to speak little closer to the mic. Yeah.
Sure. Is this better?
Little better, but if you can make it a little better more.
Yeah.
Yeah, better now.
So we were talking about the reduced interest rate in case of direct tax. Works out to be 0.75% per month for the period of delay. Of course, if the delay is made good within 30th June, if you kind of cross that timeline of or milestone of 30th June, and after that make belated payments, the interest rate would be regular and not the relief one. Similar aspects in the indirect tax bit also, customs, excise, erstwhile service tax, your GST and everything. A relief has been given again to ensure that wherever there are timelines, an extension has been given till 30th June. The only aspect that I think we must all note.
Others, we are losing you in between. Yeah.
The only aspect from a GST perspective that we need to adhere or understand is that, except for everything else which has been directly given in sort of a relief, for GST, what they've done is that they have identified certain items or certain events, occurrences as a force major event, and then allowed the authorities to kind of issue notifications corresponding to that force majeure event to give relief in these compelling situations. Now, what is interesting is that I think throughout the presentation, we've been talking about that there is disruption and there is going to be a change of order, there is going to be a new normal and all of that. I think one aspect that's flown seamlessly is the fact that we are potentially dealing with a force major event. Now, in the taxation ordinance, only for limited GST purposes, they have probably recognized the current situation as force major and have not recognized the same thing for all other laws. So therefore, there is a little bit of tricky interpretation coming out, and whether we'll be able to take support of that interpretation for all your other legal and practical purposes is one question that's arising. So, one may want to take note of that as well. Similar to direct tax, I think there is a grace period available for GST payments as well. We are talking about a 15-day grace period for large taxpayers, wherein you don't pay any interest at all. And if you pay after 15 days but before 30th June, then you pay a reduced interest rate of 9% per annum. What we need to, very importantly, and I'm re-emphasizing on that fact, need to understand is that there has been no categorical extension of any of the due dates in the law. The due dates remain where they were. So if I have to take a simpler example, if you have to 3B, the due date for 3B continues to be 20th of the subsequent month, but the grace period, the fee waivers, the late fee waivers, etc., are all available. Lower interest is available. So when you make use of some of these reliefs which have been given, what we need to appreciate is that
So,
all the
others, I
due date
think,
is extended.
others, sorry, I think your voice is not becoming audible to many. They are sending the message. So, let me take it up if we can, or if you can speak little louder, that may be better if you want to. Just try once, otherwise we will. If you can go closer to the mic, that may be better, so that it is coming and going in between.
Sure. So we were talking about the due dates and what kind of relief has been given, and specifically the fact that due dates have
No,
been
no,
changed.
no. Others, sorry. Let me continue.
Sure.
Or sorry, because it's not coming out very clear. Okay, so as a matter of fact, GST payment also there have been time has been granted to make a payment till 30th June. It is an optional. Now there are two questions which are coming up, or one needs to really looking at that as a calculation. First one, if we have an accumulated credit, we don't need to really worry about availing this option as of a 30th June, because if I have an accumulated credit, I am not getting any advantage of availing this option of 30th June. In fact, in case of an exporter of goods and they are exporting the goods, we all know that your refund is granted only when you file your 3B return. If you are opting for option of 30th June, and if you are an exporter of goods, then definitely it is not a good sign, because your refund of IGST on account of export will get deferred. And the third point is that do I really need to look at this qua the supplier? Because let's look at it in a scenario where I have paid to the supplier and supplier has opted for a time period till 30th June. Can I in that case be entitled to take a credit? Answer is yes. Given the way the scheme is section 16 read with rule 42, there is no difficulty for we as a recipient for availment of a credit even if supplier has availed the facility of paying on a 30th June. Now, we have some important caution point that we wanted to bring to your notice, that if assuming you have paid a GST to your supplier and eventually supplier did not deposit that in a government treasury, you will definitely have a loss of a credit, because in terms of section 16 requirement, GST is required to be deposited in a government treasury. Now, what is happening in that context is many of our clients have started bucketing their suppliers into two aspects. Supplier number one, where they know that the GST, if we pay it to the supplier, they will in turn deposit to the government. I don't have a threat of losing of a credit. However, we have a scenarios where GST is paid, but if supplier does not pay, probably then we will lose the credit. In that context, there are separate credit scheme being worked out. Credit mean the credit to the supplier period, or the some of the clients as large as having a large turnovers, they have put a system in place that give me a proof of payment of GST and then you take your GST amount. Or there are suppliers where these are doing a continuous business for me. Even if I make a payment of GST, if it does not deposit, I will be able to withhold some payment in the future supplies that he is making. But now supplier analysis has become a very important aspect, given that we see the cash flow crunch in the market, lot of default which will happen in days to come in terms of GST, and it should not happen that we as a recipient of such goods or services will end up losing the credit. While we know that there is this 10% of a mismatch, the relaxation has been provided for, but that is only for 3 months. Once the July onwards, this relaxation will not be there, and if they start adhering to this relaxation even July onwards, we will have a challenge in terms of if supplier does not pay that GST amount. So the other important aspect is there have been no relaxation provided for time of supply, the date of tax invoice, GSTR1, furnishing returns, and levy of late fee. Now, what is the consequence of this furnishing or returns? Now, we all know that for the purpose of various statutory requirements such as CARO audits and so on and so forth, one of the things that auditor report is the returns have been filed in time or not. We have spoken with some of the companies and their auditors have started already raising an objection that we don't mind you opting for a 9% and with a June payment, but we may be able to qualify that returns have not been filed in time, because the due date for filing return is not been extended. It is an option given for payment of tax with the interest at 9%. Therefore, on a strict interpretation, auditor may take a view that there is a delayed filing of a return and he may need to report that. Therefore, one needs to keep that in also mind once we avail this belated filing of return with a 9% interest. Yeah, Adarsh, move on. We have some of the miscellaneous amendments, which is Vivad Se Vishwas scheme has been extended till 30th June with no additional payment required. Sabka Vishwas scheme, which is amnesty for IDT, where the forms have been issued and we were required to make a payment within 30 days. That time period is falling in this period, you can pay that amount on 30th June. It is not that you have freshly can opt for a Sabka Vishwas, that's not the language. If the payment which was due in this period, you can effectively now pay that in terms of a later point in time, and you still be entitled to the benefit of the amnesty scheme if you already opted for. Go down. There are certain other recent amendments, may not be directly in the context of COVID, but few amendments in Rule 43, Rule 89, 96, 80. One of the critical amendment or two amendments we will just take for the sake of discussion, that the refunds of the GST which you have paid through using the credit, prior to the amendment, there was no mechanism or there was no provision to refund by of a recredit. Now they have got this specific provision. We believe that it was not a case that there was no refund available. Now with a specific provision, it is made it clear. Now that refund which have been excess payment of tax by using the credit will now get recredited to your credit ledger, and that has been specifically provided for. Second important amendment is 150%. If you are claiming a refund of an accumulated credit, and therefore the amendment is that the value of the goods which have been exported cannot be more than 150% of your same products when sold in India. Now, very subjective provision, lot of interpretational issues. What do you mean by similar products? Which value I should take? Should I take a value X customer or Y customer? Or how do I, because export is in relation to a related party or unrelated party, does it make a difference at all? None of this clarity being provided, but this strange provision got introduced effective 1st April, that your export value cannot be 150% or more. That means they don't want to grant us the refund, and I don't know why, who is overvaluing the exports. And if that overvaluation of exports, how can I overvalue with the unrelated party? And none of these questions get addressed, but this strange provision got introduced wherein this limit of 150% has been put it there in the context of export. Go down, others. Some of the trade measures, and very important in the context of foreign trade policy. One important thing, that FTP, which was due on 1st of April for renewal, has now been extended as is for a year. The second one is very interesting, which is validity of various licenses or certificates which have been effectively there, which is falling in terms of this period being getting lapsed. So assuming I have got an advance license, I needed to use this within a specified time for import of goods into India, and that validity is getting lapsed in this period of March and April, that gets automatic extension of 3 months. Similarly, if my export obligation period is falling into this period, I get automatic extension of 3 months. There are few cases you get automatic extension of 12 months also. So there are some good provisions where there has been extension provided for validity of various licenses and export obligation period. Now, there are some exemptions. We all know that advanced license EPCG had a sunset clause for exemption from IGST. Now that IGST exemption, which was to be lapsed on 31st of March, has been extended by a year. So import of goods against advance authorization or EPCG will also continue to available as an exemption. SCIS scheme, while it appears it is continued, but at what rate, with what notification, with what services, it's still to be notified. Whereas MEIS, which is another merchandise export incentive scheme, the interesting point is that has got extended up to 31st of December 2020. That was a clarity provided. So all exports made up to 31st of December 2020, MEIS scheme will be extended. Interestingly, that is subject to that if road tape is not introduced for that product. Very important amendment. If we have a road tape scheme, we all know that what is this road tape. We don't want to spend time on that on this issue. But if your product gets notified under a road tape scheme earlier than 31st of December 2020, you will be entitled to avail the benefit of road tape, and MEIS will be discontinued for that product. So very important, some of the big manufacturers who have MEIS is hardly 1%, 2%, but there are other inbuilt taxes are more than 2%. It may be important that is being taken up strongly with the ministry and introduce the road tape scheme for a higher product and get this benefit of a road tape. There are some procedural aspect of trade facilitation such as 24/7 clearance, expediting the processing of GST and refunds and customs and drawbacks. I don't know whether this expedition would mean only for a small players up to 5 lakhs or this is for everybody. Ideally, this should be for everybody, but one should really be pushing their own refunds which are stuck. There is avoidance of certain physical acts. You can do that through email, and that will be accepted. The time limit for completion of proceeding and filing an appeal, even under Customs Act, has been extended up to June 30th. So any appeal reply which was supposed to be filing in that period got extended up to 30th June. There are some other regulatory measures, such as that we wanted to have India's position as the paramount, and therefore export of certain drugs have been banned. There have been new restrictions have been put it in terms of the price control order. There are some exemptions which have been granted for ventilators and other products. And more importantly, we expect a lot of new policy changes which are likely to happen given what's happening in global era. A lot of manufacturing base likely to shift to other countries from China, and India is one of the definitely looking forward for such base be attracted in India with a corporate tax rate of 15%. India is making new policies, giving a lot of incentives to promote Make in India, and one needs to be really looking at in terms of such a new policies which will be introduced. Moving on to the last part of our presentations, which is this is okay. Rules of origin has been also for the time being. You can clear the goods based on the country of origin. Around the world, what's happening? If you see, most of the countries have granted a deferment of payment of tax. But look at it, the third scenario. In the context of France, Indonesia, Italy, Australia, they have actually come out with a tax remission scheme that you collect the tax from the customer but don't pay to the government. Very interestingly, that they want to support the sector where they have come out with a tax remission scheme. Maybe look at it, the last point on the last bullet on the slide, in fact, where the mobility has been relaxed as a Singapore one. If you are on account of lockdown, if you have been stuck in Singapore, that period is not be considered to calculate the residential status in Singapore. Very interesting different actions have been taken by the countries globally to support this COVID-19 situation. We will stop it here. I'm happy to take questions. I am joined for question and answer our partner Nishan Shah. We also have Adarsh, Jignesh Gelani. We also have Pranav. So all of us would be happy to address any questions that any one of you have in relation to this issue, and happy to also address any questions through email as well post this session.
Rohit, Nishant here. So it's excellent presentation, quite detailed presentation. Rohit, just for the listeners, just to highlight one which we are actually experiencing from our clients is that all of these issues which we highlighted may not be within the ambit of the finance or the tax department, and at times it is within the ambit of the supply chain or the sales and procurement, and they go ahead and take certain steps which without understanding the tax implications. So immediately it may be important that you educate each of these departments, or at least convey that if any action is being taken because of COVID, it could have repercussions from GST, because that does not come through naturally that any such action will have a GST implication. But as we saw, like Rohit took us through the detailed presentation, that there is an implication from a GST perspective arising on smallest of the small action being taken on account of the COVID-19 situation that we are in right now. So with that, we open the floor for question answers, and we'll be happy to respond to answers.
Anybody who have a question, please unmute their line and speak. If you want to put it on chat also, you can put that on chat as well.
Hi, Rohit Murthy here.
Yeah, hi Murthy.
Yeah, I have two questions here. Thanks for the presentation. One is when we claim this insurance on damaged goods, no?
Mm-hmm.
Can you hear me?
Yeah. Yes, I can hear you. Yeah.
Many times what happens, the insurance company will not accept to settle with GST. The reason being what they are quoting, whatever you are giving replacement, at the time you will not pay the duty, you are paying only once. So that once you claim it from the customer, and the second time when we supply against as a warranty, so where you are not paying the GST, so I will not pay the GST to you as well. So is that the stand is correct? That is number one, can give a clarity. And second one is this BCD on DTA clearances, BCD payback, no, from the this one EOU units, which has to be paid back on the subsequent month, 10th of every month. So in the March month clearances, April we have not paid. As per the extended rules, whatever the schemes announced by Government of India, whether this payment also can be made before 30th of June?
So
These are
two
the two
questions.
Okay.
Yeah, two questions. Murthy, Nishant, Jignesh, Adarsh, anybody wants to take up? Pranav.
Sorry, Rohit, I could not hear that very clearly.
Yeah,
So,
Yeah,
I can
Jignesh.
take up the first question, Rohit. I think I could hear the insurance aspect clearly. So,
Yes, go on.
insurance is okay. Insurance, yes, from a GST perspective, it is clear that to the extent you are able to recover from the customer, that will not form part of the insurance claim. So that has been something which the everybody is being facing that issue. Murthy, if I have understood you correctly, right?
Yeah, correct, Jignesh.
So that has been the case because you have been able to and you have a right to recover from the customer. So that
But at the
has been,
same time, I think, Murthy, it is also not correct on account of insurance companies that you recover from customer and we will not pay. There are cases we have seen in the past that if you don't have an ability to recover from customer and it is getting actually lost. So let's take a case where goods lost in transit and
Yeah,
damaged, and where customer is forget about paying the insurance. They are not even paying the value, not even paying GST. In that context, clearly you can include the GST as an amount as part of your insurance claim. So it all depends upon each scenario and what sort of an insurance policy you have. But it is not a universal stand that GST once will not be included as part of a claim.
absolutely.
Yeah. So
yeah.
can I take the second one?
Yes, Adarsh, please go on.
Sure. So, sir, if I understood your question, it was really that, where the facilitation of making BCD payment cumulatively on a monthly basis is available, whether deferments would apply to those kind of compliances as well. If I go back to the taxation ordinance, particularly in context of customs, I think the relief is only about procedural aspects and compliances other than duty payments. So, at least kind of cases the view coming out of the ordinance is that, there is no deferment or there is no grace period, as we were calling it during the discussion, also would be available for your duty payments.
Oh, okay.
There is one more question, Rohit, which has come in the chat box,
Mhm.
which says that government has practically not extended the due date of filing
Yeah, so
3B.
that we
That
had that we have effectively said that on a strict reading, few auditors have already opined that they will have to qualify the report being delayed filing even under the CARO, and they will not be able to take a position that this is not a delayed filing. So you are right that if the 3B timeline has not been extended, this is an interpretational issue which is coming up.
absolutely.
correct.
Okay. Another one point, Rohit Murthy here. This inventory loss, when you discussed about the ITC and other things to be reversed in
Right.
the different scenarios, I have
Mm.
one general question. The moment when you create a provision in the books for whatever is the reason slow moving, I have not removed the goods from our warehouse. Goods are still lying, but there is a momentary issue. I may create some provision. Basis the provision created in the books, should we need to reverse the credit ITC?
Jignesh, Adarsh, 17.5, you want to talk or should I answer?
I could not get that. Our voice was breaking.
You see,
If Murthy,
even if it is merely provided and not written off as a slow moving, do I need to reverse the ITC credit?
Yeah, sir, I can take that probably.
Yes.
Go ahead.
So, Mr.
Your voice
Murthy,
is not clear. Jignesh, can you, sorry, Rohit
Yeah,
is there.
Adarsh is answering Mr. Murthy. Yeah.
sure. Sir, I think if we look at the context of section 17.5 under GST, I think
Yeah.
the identified events, goods lost, damaged, stolen, etc. I think some of those things are, events that need to occur, right? I mean, when I look at
Yeah.
a scenario wherein, we are talking about only a provision created and not really a write-off being done in the books, one may very strictly take a view that you have a good case to argue that no ITC reversal should happen only basis the provision. But again, see, accounting is a complicated aspect. What we need to understand is, you know, which, which way are you accounting, some of these aspects. And I think then on a case to case basis, this answer may differ slightly.
Just to add what others shared, Mr. Murthy, in the
Yeah.
erstwhile provision, there was a specific, mention about provision as well, erstwhile law, that provision or written
Yeah.
out. That is not there in the present law. So what Adarsh is saying, if you strictly go, if you really write off, provision is provision for all purposes, you reverse off, you reverse the provision entry, and actually when you decide to write off, then you write off. So strictly speaking, I mean, it goes with write off, but yes, it depends upon, how are we treating also in the accounts.
Fine. Thank you. Thanks to all. Rohit and all.
Okay. Hi, this is Vanita. I have a question regarding the TP adjustment invoice, which you spoke about. If we raise in relation to supply of goods, whether we'll be able to claim the refund on that price adjustment if I'm receiving the money from foreign customer as a supply of goods?
Sorry, in the context, you have supplied the goods, you have raised an invoice, and then
Yes.
what are you receiving as a price adjustment means what?
So basically,
Your
I am
upward revision or downward revision? Upward revision.
upward.
Rohit, can I take that?
Yes, please take it. Yeah.
Yeah, see, let us go to the basics. If I am looking from a refund from a GST perspective, export of goods really did not have that condition that you need to receive currency in foreign exchange. But if you see the recent amendment, they have made it in the notification in the rules, not in the act. That's a separate issue altogether. Can a rule override act? Now, keeping that aside, they have clearly mentioned that the refund will be available to the amount money has been received in case of goods. But yes, if you receive at a later date, then also there is an ability. I think the timelines, if my memory serves me right, is around 3 months, from the date of the receipt of additional foreign exchange, you may be able to receive that. But I think principally, this condition that, in order to qualify as export of goods was, you need to receive foreign exchange was not there. I hope it answers your question.
Okay, but when the officer will reconcile it with the shipping bill, obviously there is no shipping bill. Then there won't be any issue in like practically
So what,
keeping
Vinita, we
the.
have seen that if it is an upward revision of the value of goods, you may probably need to go and amend the shipping bill as well, if possible. We have seen in the past, in
Absolutely.
few cases, we have carried out the amendment to the shipping bill. As long as at the time of supply, you knew that there could be potential upward revision will happen, subject to certain factors which have been considered. If it was not new and suddenly after shipment your customer has agreed to pay you more and there was some upward revision happened and you now therefore can't amend the shipping bill also, then authorities may say that we will not consider for granting an IGST refund or a proportionate refund, we will not consider this upward revision value.
Okay.
Hi, Gopal. The next question which is there in the chat box is that if the GST collection is linked to the receipt of payment instead of billing, then that would ease the liquidity situation. So how do we tackle that?
I agree, Gopal. You want to take up that? You please go on.
So as of now, as of now, there is no such prescription in the law. But yes, this is one problem which is being faced by all, and again could be a subject matter of representation. And some of the representation made by FICCI and other organizations, the associations, has been to this particular aspect to ease out the liquidity.
That's right. Because some examples, some associations, as rightly pointed out by Gopal, had filed the representations seeking that please defer the GST liability only on a receipt basis as opposed to an accrual basis. But I think government also need to manage their resources, and this will be a fundamental change in the scheme of tax itself. So one needs to be really careful about in that sense.
And Rohit, just to add, as a corollary, then government, because right now that provision is just 10%, that is also been deferred. So they may say that even where a credit is to be availed by the recipient of goods, unless the payment is made by the supplier, the credit will not be available here, which currently has been deferred. So, like you mentioned, that the government will also have to see the balance of payments in their hand.
Sir, there's another question coming up, which is regarding the interest implication on this deferment of the 10% rule. That's regarding the unmatched credit. You want to address that?
Others, you take it and address as well.
Yeah, sure. I think if you look at the change in law, what the new proviso is suggesting is that for the period of February to September, the reconciliation or the matching has to be kind of trued up by the end of September. Now, having said that, because it is categorically coming in the law that the timeline itself is September to prove whether something match or not match, I think so long you finish the exercise of true up by 30th September and then report it accordingly in the September returns, we believe that there is a very strong case of no interest being leviable because the law itself mandated a particular timeline or a due date for that. Now, having said that, I think the rather interesting question would be that, let's say if somebody is not doing the true up in September, but doing the true up only in the month of October, then there is a grave case that the interest may probably apply from the date you availed the credit. So to that extent, the suggestion recommendation here would be that, wherever we are taking these unmatched credits, this should strictly be reconciled and reported in the return for the month of September. And that will help you to potentially avoid any interest implications there.
Right. Okay, I think we ran out of time, but we once again thank you all participants for joining this ELP webinar on impact of COVID on tax matters, and we once again look forward for joining any other webinar that we may conduct. And thank you once again. Feel free to reach out to us for any queries or any questions that we may have. Happy to answer those. Thank you once again.
Thanks, Rohit.
Thank you, everyone.
Thanks,
Thanks.
Nishant.
Thank you. Thank you all.
Thanks, Rohit and all. Murthy here. Bye bye.
Thanks.